Boost your financial analysis skills with Balance Sheet Mastery. Hello viewers and subscribers, and welcome to today's video. In this video, I'll examine how investors and business owners should analyze balance sheet quality. I will pose certain questions you should be asking, discuss how to perform a common size analysis, a ratio analysis, and identify red flags to look for. Whether you're an investor or a business owner trying to understand the quality of your balance sheet, knowing how to perform a balance sheet quality analysis is essential for making informed investment decisions or improving your company's performance. Join me as I break down the steps to a great balance sheet analysis. By the end of this video, you will have the tools and knowledge to effectively assess the quality of a company's balance sheet and identify strengths and weaknesses in a company's financial position. This will help you to make smarter investment choices and business decisions. Don't miss out on this essential guide for investors and business owners. Make sure to like, subscribe, and hit the notification bell for more financial literacy content. Join us on this journey to becoming a more savvy investor and business owner. Balance sheet quality analysis. The balance sheet shows the financial condition of a company. It has three components: assets, liabilities, and equity. It shows the liquidity position of a company, that is, whether it has adequate cash to meet operating expenses. Insufficient liquid assets could lead to bankruptcy. A high-quality balance sheet has properly valued assets and liabilities whose maturities match, high liquidity, manageable debt. A low-quality balance sheet has hard-to-value assets and liabilities whose maturities mismatch, poor liquidity, large debt. When performing balance sheet quality analysis, weigh high-quality features against low-quality features to determine overall balance sheet quality. We will now go into the 4 steps we follow when performing balance sheet quality analysis. These 4 steps are: 1. Answer some relevant questions. 2. Perform common size analysis of the balance sheet. 3. Perform ratio analysis. 4. Combine steps 1 to 3 to form your overall conclusion. Step 1. Answer the following questions. Are the assets and liabilities fairly stated? In relation to the liquidity question, are there overseas or restricted cash? Does the company have a lot of debt? Question 1. Are the assets and liabilities fairly stated? You cannot tell from looking at the balance sheet. Review footnotes, MD&A, management's discussion and analysis, and SEC comment letters for major assets and liabilities. Qualitative and quantitative factors affect valuation. Factors affecting asset and liability valuation: understated or overstated reserves, for example, bad debt allowance. Deteriorating operating performance. This might pressure management to overstate assets or understate liabilities. Qualified audit opinion. Internal control weaknesses around assets and liabilities. Impairment results in lower asset values. Factors that could lead to impairment include falling profits, unprofitable business segments, loss of patents. Question 2. Are there hard-to-value assets and liabilities? Hard-to-value assets and liabilities require significant judgment and assumptions. These include Level 3 securities, for example, private debt and equity, over-the-counter derivatives that do not trade on exchanges, intangible assets, contingent liabilities, for example, a legal judgment against the company. Hard-to-value assets and liabilities increase the risk of a misstated or fraudulent balance sheet. Question 3. Do asset maturities match liability maturities? Look for mismatches between asset and liability maturities. For example, a company with mostly non-current assets and mostly current liabilities. Such a company might be unable to meet short-term obligations. Pay attention to cash and debt mismatches, that is, short-term debt but little cash and liquid assets. Question 4. How liquid or leveraged is the balance sheet? Liquidity refers to how much cash or near cash assets a company has on its balance sheet. Leverage refers to the amount of debt a company carries on its balance sheet. Liquidity ratios include current, quick, and operating cash flow ratios. These should ideally be above 1. Leverage ratios include debt to equity and debt to capital. These should ideally be below 1. Interest coverage ratio is another leverage ratio, and it should ideally be above 1. There are exceptions for some industries. For example, real estate investment trusts are usually highly leveraged. Use of debt is part of their business model. However, they still need to generate cash to pay their debts. Here are some things to consider when analyzing a company's liquidity and leverage positions. Does the company have cash held overseas? Taxes may be due on this cash if it is repatriated. This means the company would have less cash available than stated on the balance sheet if it repatriated the cash. This information can be found in the MD&A and tax footnotes of a company's 10-K filed with the SEC. Look if the company has any off-balance sheet contractual obligations which are not captured on the balance sheet. This can also be found in the MD&A section of the 10-K. Look for debt covenants in the MD&A and in the debt footnote. If the company is close to breaching any covenants, this is a red flag. Does the company have the ability to refinance debt that is due or will soon be due? Some companies borrow at the beginning of the period and repay their debt at the end of the period to hide their true debt. Such disclosures can be found in the MD&A and debt footnote. Step 2. Common size balance sheet. Express financial statements in percentage terms. Over multiple periods, there are two types of common size analysis: vertical and horizontal analysis. Vertical analysis: express assets, liabilities and equity items as percent of total assets. Liabilities plus equity equals assets. Horizontal analysis: compare change in balance sheet items year over year. For example, receivables increased over prior year. You'd want to know what's causing this, what to look for in common size analysis, trends and relationships between items. For example, sales growth in relation to receivables growth, changes in individual items. For example, inventories increased by 50%. Assess impact on earnings, balance sheet and cash flows. Assess management explanations for reasonableness. Red flags. Here are some red flags to look for when doing common size analysis. 1. Receivables are growing faster than sales. The company could be recording revenue too fast, having collection problems. It could lead to bad debts. 2. Inventories are growing faster than sales or cost of sales. This could lead to excess or obsolete inventories, risk of inventory write-offs. The risk is higher if the increase is in finished goods inventories. 3. Reserves as a percent of assets increase. The company could be creating a cookie jar that it could empty in the future to boost earnings. 4. Reserves as a percent of assets decrease. The company could be emptying the cookie jar. This would boost earnings. 5. Long-term debt increase and interest expense decrease. The company could be capitalizing interest. This would reduce expenses and increase profits. 6. Operating expense as a percent of sales decrease. The company could be capitalizing operating expenses. This would reduce expenses and increase profits. Step 3. Ratio analysis. Here are some actions to take when performing ratio analysis. 1. Examine the relationship between financial statement items. 2. Review large, unusual changes and trends in ratios. 3. Look at trends in ratios over several years. A single year change could be misleading. A worsening trend is more troubling than a single bad year. Ratios that impact the balance sheet. Asset-liability turnover ratios. These measure how quickly assets and liabilities are converted to cash or are paid for. Liquidity ratios. These measure a company's ability to meet short-term cash needs. Solvency ratios. These analyze a company's capital structure, that is, the level of debt and equity used to fund operations. Here are some examples of balance sheet ratios. Quick or acid test ratio. It is calculated as current assets minus inventories divided by current liabilities. This is a liquidity ratio. It tells whether a company can meet its current liabilities. If it is below 1, the company may not be able to meet its current liabilities. Cash ratio. This is another liquidity ratio. It is calculated as cash and cash equivalents divided by current liabilities. It tells whether a company can meet its current liabilities. If it is below 1, the company may not be able to meet its current liabilities. Operating cash flow ratio. This is also a liquidity ratio. It is calculated as operating cash flow divided by current liabilities. If it is below 1, operating cash flows might not be covering current liabilities. Days sales outstanding or DSOs. This is an asset turnover ratio. It is calculated as receivables divided by revenues divided by 365. It measures the time taken to collect receivables. The higher the ratio, the longer it takes to collect receivables. Long collection period could lead to collection issues and potential receivables write-offs. This could lead to lower receivables value. days inventory outstanding or DIOs. This is another asset turnover ratio. It is calculated as inventories divided by cost of sales divided by 365. It measures the time taken to convert inventories to sales. The higher the ratio, the longer it takes to convert inventories to sales. Long conversion periods could lead to obsolete inventories, write-offs and lower inventory values. Debt to equity ratio. This is a solvency ratio. It is measured as total debt divided by shareholders' equity. It tells how much a company is dependent on debt to fund its operations. The higher the ratio, the more the company is dependent on debt. Debt to capitalization ratio. This is another solvency ratio. It is measured as total debt divided by total debt plus shareholders' equity. It tells how much a company is dependent on debt to fund its operations. The higher the ratio, the more the company is dependent on debt. Step 4. Put it all together. Combine your findings from steps 1 to 3. Assess overall balance sheet quality. Document your findings. Create a report that summarizes the findings from your balance sheet quality analysis. This will later be combined with your earnings quality and cash flow quality analyses, which I will be covering in other videos. Consistent process improves analysis and decision-making capability. And that brings me to the end of the video. Thanks for watching and remember to like, share and subscribe. See you in the next video.